Well, welcome everyone to tonight's asset protection webinar. If you're brand new to this is an ongoing webinar series. It's been going for over 2 decades. We're happy to have you here. When we teach, we've had some really good presenters on. Even in the last year, we've had Toby Mathis, Dr. William Danko, co-author of The Millionaire Next Door. We've talked about cost segregation, and we've had Jill Banner, president of iPlan Group here, Scott Estel, a former senior trial attorney from the IRS. We've had some heavyweight speakers.
Even Mr. Wonderful.
Oh, that's right. Kevin O'Leary was on here a couple of months ago. Cool. And divorce attorneys, and we've covered a wide variety of topics. And if we do record each one of these, and the recordings are usually available within a day or two on our YouTube channel. And so all you'd have to do is go to YouTube, type in Protect Wealth Academy, and hit the little subscribe button. And that way, whenever we post anything new, but there's close to 200 hours of webinars that we've done in the past, recordings. And then anyone who registered for tonight's webinar, or whether you attended or not, will get a recording tomorrow. So yes, it is being recorded, and you'll get a recording. However, you can't ask for recording questions like you can tonight. So we're happy that you're here live. We appreciate you being here. Thank you. And then, as most of you know, we teach 3-day asset protection summits. Here's a little of the lineup that we've got coming up. We've got 2 events that are happening right away. The one in 3 weeks from yesterday is a live event. We're live in person. We've got a tremendous lineup, and the benefit for this is we get a chance to sit down with you one-on-one. You can talk to almost any of the presenters, sit down, ask them questions, go over your estate. Somebody will be there to help you set up a blueprint, how it ought to look, or at least make some suggestions. That one in Phoenix there's $99. It's kind of a seat reservation because we've got a limited number of seats. We're taking almost a seat reservation so we don't overfill that class. But the live stream event is free. You're welcome to attend that, but it's not till November 14th, so you got a couple months to wait for that. Looking very much forward to that. Scott Estel, former senior trial attorney from the IRS, will be there. Dr. Danko, we're planning on him at least in the November class. Jill Banner is often at this. Mike and Stacy, Koval, Acevedo are there. We will normally have 10 to 12 speakers at every event. So encourage you to attend these classes whenever possible. And this November class, or I'm sorry, the October class, if you're interested in that and still on the fence, the room reservation, we've got a very nice discounted room at the Hilton. It's an airport hotel. It's easy to get to, free shuttle back and forth. It's a nice hotel, but our room block ends on Friday. So if you're interested, don't wait, or you'll be paying full price for the hotel. So by Friday, if you're interested in that, sign up for that October event. Okay, before we ever talk tax and legal, there's always a disclaimer. We can teach general principles, how they apply to you and your situation. I don't know. It's probably a good thing to talk to your tax professional, but as all we can do is teach good asset protection strategies. Is it relevant to you in your situation? Come to the summit, sit down with our people, and let's see, or talk to a local tax professional. Anyway, and we'll give you an opportunity at the end for a consultation to see whether what we're talking about is relevant to you and your situation. So with that, I'm going to tell you, I've had so many questions over the years about nonprofits. Every time I go out and speak to people, And I can answer a lot of the questions, not like our expert tonight, but I can answer a few of the questions, but we haven't had a really good solution up until now where we can refer somebody interested in nonprofits to a really good local or a really good attorney. We're so excited to have tax attorney. He worked, Karim Hanafi. He worked for the IRS for a number of years. He's got a slide or that'll show his background. But I'm really, really excited to have him, his expertise. I'm excited for the topic because I know it's relevant to so many of our clients, to so many of our students. So Karim, turn time over to you. Thank you for being here. I know it's Eastern time and a little late for you, and appreciate you even more for that. So the outline I think that he would like to use is he's going to present. If you can hold your questions, or you go ahead and type them in, but his presentation, I believe, I've gone through the PowerPoint. I think it's going to answer most of the questions you're going to have. So write your questions down. We do want to get to them, but we'll probably get to them at the end, if that's okay. And then we'll answer your questions. We do want to get to them, but let's go through that. So Karim, turn time over to you. Thank you so much for being here. We're delighted to have you.
Oh, thank you very much. Really quick, can I share the screen here?
Yes.
It says it will stop other screen sharing. Do you want to continue?
Yes, that's great.
Okay.
Knock me out. I'm good.
Okay.
I'm ready for it.
All right, let's see here. All right, let me share my screen here. Let's see if it'll come up. Should be able to see it now. All right, I'll go to the very, very top.
Perfect. And we'll be in the background if you need something.
Okay. Thank you all again. My name is Karim Hanafi. Now, Don said, as he mentioned, there are about 70 slides here, but I'm going to be able to go through these fairly quickly. So that's the goal. That's the objective here. Again, as Don mentioned, my name is Karim Hanafi. I've been working with Anderson Advisors. Now, before I give you the intro about myself, and here it is kind of briefly, I'm going to go to it again in a minute. But before I do, you know, if you've been to any of the other presentations that I've done, sometimes I like to do a little bit of a skip before I start. So I'm one who loves the 80s. I love 80s music. I love anything dealing with 70s and 80s and classic rock and 80s stuff. You're not going to stump me on any of this stuff. In fact, I've always got a vinyl in the background. And this one is, you know, this is a softball here. So this one should be easy for anyone to figure out. Now, as I, you know, like to do these sessions and everything, I tell them, you know, I like to turn to my daughter to get her advice because, you know, I'm an 80s guy, but I want to be hip and cool, as I told her. And, you know, she looks at me and she's like, you're such a boomer. You know, no one says hip. No one says cool. I'm like, well, you know, I want to be a hip and cool dad and a hip and cool boomer. So, you know, help me. So, you know, she's like, okay, let's do some videos here. So this is what we do is we warm up our sessions every morning. You know, myself, you know, I like to get started. All right, so there you can see my my incredible skills doing 90s music, but that's not all I do. I can do, you know, some 80s stuff too. So I'll also do that.
I got shorties with me -7, that's 3. Ooh, spray, fresh, Febreze. I shoot like a picture. She shout out my brother. Hey Lee, hey bro, dump his body in a creek.
So there you have it. So that's how I start each one of my day, you know, each morning here before I get started with it.
Do you remember what he was singing?
I think it was that song, I Want It.
This is one that my daughter wanted to do. It was a TikTok thing. So what she wanted to do is she wanted, as I should probably go back one because it just doesn't look right there the way it is. Anyway, she wanted to do a TikTok that recreates Brooklyn Nine-Nine. And in that skit in Brooklyn Nine-Nine, someone had heard a murder. She doesn't know what the person looks like, but she knows what the person sounds like. So in the police lineup, each person has to sing a song, which is Backstreet Boys' I Want It That Way. So My daughter is she's the cop, and my daughter is also number 4, and I am number 5. So here's how it goes.
Do you remember what he was singing?
I think it was that song, I Want It That Way.
Backstreet Boys, I'm familiar. Okay.
Number 1, could you please sing the opening to I Want It That Way?
Really? Okay. You are my fire.
Number 2, keep it going.
The one desire.
Number 3,
Believe when I say.
number 4,
I want it that way.
tell me why.
Ain't nothing but a heartache.
Tell me why.
Ain't nothing but a mistake.
Now number 5, I never wanna hear you say, woo!
I want it that way.
Oh, chills, literal chills.
It was number 5. Number 5 killed my brother.
Oh my God, I forgot about
So there we go. Some of my favorites.
Do you remember?
I love going through it. So anyway, that's how I start my mornings.
Okay,
All right.
Karim, we think you're hip and cool,
You're hip. You're totally hip.
or whatever that's worth.
Yeah. Well, I see people posting on here, so thank you. You know, it's good. Some laughs in there and all. So I love the videos myself personally. So in any case, now a little bit about myself. You know, I don't just do taxes. I like to think that there's some depth to what I do in terms of my background, my sense of humor, and sort of the entertainment that I have with it all. You know, I really enjoy doing all of this, at least these activities and stuff. So now a little bit about myself. I've been working in this area for about 20 years. So when I actually left law schools at Georgetown and I wanted to work in tax, I really wanted to work in corporate tax area. That was my dream, you know, to work with Fortune 500 companies and talk about tax planning. But, you know, once I left Georgetown and I wanted to work at the IRS, the only positions that were available at that time were in the Tax-Exempt Division. So I thought the same thing, you know, working in the IRS, I'm going to get the experience. I wasn't sure if this is where I wanted to work, but I did, and I worked there for about 5 years, and I loved it. I loved working in this area. I left the IRS to go move into private practice, and I've been in private practice since then. So I worked for a law firm. It was called Sutherland, Asbill and Brennan in Atlanta, Georgia. I worked there for 5 years. I believe they're called Evershed Sutherland now. So I worked there for 5 years, and then I went on my own in private practice because the billable hours were too much, and I wanted to spend time with my kids. They were 2 and 5 years old, and I wanted to watch them grow up. So I basically worked from home doing this for about 15 years until the pandemic came along. And suddenly it was very common to see companies wanting to hire you to work remotely. So Anderson came along. I actually hadn't even heard of Anderson, not Anderson Business Advisors out of Las Vegas. It came along just on a whim on LinkedIn where it says, my name came up in a search. So it says Anderson. So I look it up, I apply for the position, I meet with the CEO and with Toby. And basically within about 24 hours, they offered me the position there. I didn't know what to expect, but I can tell you, I love working for Anderson. You know, the amount of clients that I have met since I've been there, you know, when at the law firms and even on my own, a good year would have been, you know, 50 to 100 applications. 100 applications would be great. Last year at Anderson, we did over 250 applications, and this year we're probably on pace to about 300 applications. So it's amazing the volume, the amount of work, the number of clients, and the interaction that we get with all of these clients. It's tremendous, and I've loved it. You know, I've honestly loved every day that I've been working with Anderson. It's been about 18 months. In my experience now with Anderson, I am basically filing these 501c3 applications. But in the past, I've worked, you know, handling an IRS audit, advising private foundations and public charities on compliance and with the audits. But, you know, primarily right now, it's applications, reviewing their tax returns, helping with the compliance, dealing with the Charitable Solicitation Registration, these tax filings, and then also the donor acknowledgement letters. And I'm going to go over, you know, some of these items today. So, you know, many people always ask, you know, why set up a nonprofit? And, you know, I love it because of the benefits you're going to see of helping the public. you're going to provide a service, you're going to provide a benefit where there is a need in society. You know, we always know that low income families is probably the most common, is dealing with in any area. As we're seeing now, there is quite a significant amount of people in tremendous need for something. It could be medical expenses, it could be just everyday expenses, covering their bills, you know, food, clothing, shelter, you name it. There's always a tremendous need in our communities, and that's what the nonprofits want to do. They want to help others where there is a tremendous need. I'm going to show you in a minute kind of what sort of things that Anderson has been doing and who they've been representing. Now, of course, there's many benefits because, let's be honest, even though you want to, you know, help people, we all do, we also realize and recognize there are tax benefits as well. And without these tax benefits, it would probably reduce the amount that you can receive in contributions, the amount you can receive in donations and in funding, whether it's grants or individual contributions. Of course, we know contributions are tax deductible, provided that you do itemize your taxes. You itemize the deductions. If you just take standard deduction, then maximum is going to be $600 for a family, $300 for each individual. You're up to, under the CARES Act, it was 100% of your AGI for cash contributions to a public charity, but now it's back to 60% of your adjusted gross income. That's how much you can deduct for a cash contribution. Of course, you can donate appreciated assets. So, you know, you have stocks that's gone up in value. To avoid paying the taxes on that appreciation, you can donate it to the nonprofit and get the tax deduction, you know, for the fair market value of those appreciated assets. So that is certainly another benefit as well. Of course, you know, for nonprofits, they don't pay income taxes on any contributions or grants they receive. They don't pay taxes on stocks, not on rental income, not on royalties, not on anything that's related to the charitable purpose as well. So all these, even if they're not related, you don't pay taxes. In addition to that, if you're generating, you know, fee for services, but it's related to the charitable activities, charitable purpose, you don't have to pay taxes on that either. So think like a museum, even a university, the same thing. You don't pay on the fees for services. There's also state and local benefits. Now, I'll tell you, we don't know about the sales tax. A lot of states say yes, but many say no as well. And the same with the property tax. It's going to depend on the type of activities that you're doing. A lot of states are pretty broad, but others, it's going to be specific to the type of activities that you're doing. And then, of course, your state income taxes, if you have to file it. You know, not all states require you to file an income tax return, not for a state income tax return, not for the nonprofit, but for the federal, you will, for sure. Now, I've listed here the estate tax exemption. What my whole point with this is that, you know, it depends whether you're Republican or Democrats that's controlling Congress. Right now, we see that the Democrats sort of control. We know that, you know, you're kind of at a deadlock here, about 50-50 is what we're seeing with it. But if it's up to the Democrats, we know they're going to want to reduce this exemption. So, you know, we see that it's going to sunset. We see it's up to 12 million per person now, but there's a chance that it could be reduced significantly. And if it is, then what you will see, you know, potentially is people will want to put the money into a 501c3 because it can take it out of their estate and put it into a nonprofit. That's what we've seen in the past. It doesn't mean it's going to happen this time, but that's why I'm sort of listing and highlighting this point, is that, you know, it does depend on whether the exemption will be raised or it's going to be lowered, that we see that a lot more want to set up a nonprofit for that reason. As I mentioned here, contributions are tax deductible up to 60% of your adjusted gross income. And I've given an example. If you assume that your income is 150, then that means the maximum you can deduct if you donate to a public charity is 90,000. Now, keep in mind, that's the maximum you can deduct in that year. It carries forward for the next 5 years. So, you know, you may not get the benefits now, but you will get the benefits at some point down the road. This also assumes that you are a public charity. Now, there are distinctions between public charities and private foundations, which I'm going to go over in a little bit. A lot of people think it's a great idea to set up as a private foundation, I don't think it's a good idea at all. I don't recommend it, and I'm always discouraging organizations or individuals to set it up as a private foundation. It just seems more appealing, and it seems like it's as if you're carrying that legacy, and you can through the private foundation, but you can also do it through the public charity as well. And I've listed the example here with appreciated assets. So it's beneficial for a high income earner. So we have a lot of clients who are either donating stocks, they've been donating crypto, and they donate the real estate. All of these things, these are the common things that they do. Now, it's not cash, it's non-cash. So you are limited to 30% of your adjusted gross income. It's not 60%. The same thing applies. It carries forward into future years for the next 5 years. So you can get the deduction for that in future years if you can't get it all in that first year. But you get the same benefits again, donating the appreciated assets, you avoid taxes on the profit, and you can deduct the fair market value of the appreciated assets too. And I've given an example here. So, assuming it's 150 again, this time, instead of being able to deduct 90,000 in the first year, you can only deduct 45,000, and the rest gets carried forward. And I mentioned here, and I had it on previous slides, so I'm just going to sort of jump from this one. But as I mentioned, any income related to its charitable activities, and that's kind of what the difference is here. But again, a tremendous benefit of 501c3 not having to pay taxes. We do a lot of tax returns at Anderson. I've seen a lot of them. And here's just an example of one. If you look at line 19, that is your net income, $6.3 million. You don't pay any taxes on the 6.3. Imagine you're a corporate entity. You're looking at, we'll call it $1 to $2 million is what you could be paying potentially in taxes. You don't do that with a nonprofit. There's no taxes on that if it's all related to what the nonprofit does. And for this, the program service revenues, generally speaking, are almost always, when they call it program service revenues, these are services that are directly related to the nonprofit's activities. And for that reason, it's not taxable. You see the investment income as well, not taxable. And then of course, the contributions and the grants. Now I will say one thing about this, just to, in the interest of disclosure with this, 6.3 is your profit. Now, if you remove the contributions and grants of $28 million, then you're operating at a loss of $22 million. So, for nonprofits, the big key is going to be contributions and grants and donations that you get from the public. It's not going to be the program service revenues. What's going to make the difference to make you profitable is getting those donations. For many, they do struggle with that, and that's where the challenge can be for a lot of nonprofits. But then again, we have a lot of organizations that have been extremely successful in the fundraising too. It just depends on how passionate and how involved you want to be with the nonprofit. Sort of an overview really quickly. We have close to 2 million right now. You look at 72% of them are public charities versus 7% are private foundations. So if you are a 501c3, you're either going to be a public charity or a private foundation. It's one or the other, that's it. Then there's other 501c organizations, C4, 5, 6, 7, up through 29. So up to 29 others. We at Anderson don't do any of the others. We can, but we know a lot of them want the tax benefits. So we immediately say if they're thinking of a C4, if they're thinking of a C6, a C7, because those are the most common outside of the C3. We tell them up front, you're not going to get a tax deduction by setting it up this way. So then they decide they want to go with the C3. Again, it's just that they're not informed and not aware of the differences between them, but realizes that where it is and where it all is going to be as a 501c3. Now, as I mentioned, two types of 501c3s. We have public charities and private foundations. Here are the two distinctions. The private foundations, and you can think of the Gates Foundation, that's what always comes to mind. It was set up by one individual with a significant amount of stocks that was donated to set up and to fund the foundation, and it was able to help it operate in perpetuity. He doesn't need to raise any money from the public. It's over 50 billion in terms of assets they have at this point. And, Microsoft is, it's not at an all-time high now, but it was at the end of last year. So you see that, relatively speaking, from the time that he set it up until now, this thing has gone up, 10, 20 fold. And as it was, he was still worth in the billions before that. So he doesn't need to raise any money. And that's typically how the private foundations work. They fund it, a very wealthy individual funds it and is not seeking public support or donations. It's also controlled by the founders, but they may add additional members. This is typically how a foundation works. I'm going to tell you, at Anderson, almost all of our clients are public charities, and almost all of them can have control as founders of the public charity. You can have different board members. We always encourage that, but we also have a lot of public charities within Anderson where they're related board members. They all are family members, husband and wife and kids, and they're all on the board and they're on the public charity, and that's perfectly fine too. The two distinctions between that of being, the board members is also the funding, the fundraising. With the private foundation, they're not seeking any more support, but with the public charity, they're always seeking support from the public. Could be from other private foundations, or it could be from private foundations, other public charities. It could be from corporate grants or corporate entities or government grants. So these are all of the types of funding that they receive with a public charity. And another big distinction is the deductibility. Cash donations, as we have here, 50 to 60%. We said 100%, but now it's back to 60%. So my whole point is showing you it kept increasing. It went from 50, it went to 60, it went to 100. But for private foundations, it stayed the same. 30%, it's how it's been since 1969, when they passed the act creating private foundations, and that hasn't changed. When you look at long-term capital gains for the stocks, 30% of your adjusted gross income for public charities, only 20% for private foundations. So you see that there's more tax benefits of being a public charity versus a private foundation, but there will be more, and I'll explain that to you toward the end of this presentation. These are the benefits, of course, creating a legacy for you and your family. And this is the one thing that Anderson likes to preach to our clients, create that legacy for your family. Obviously, you want to make a difference. And then finally, this looks great on your resume. Imagine having your kids, and I can tell you, we did the same thing with my son as he was applying to colleges and universities. And, he's attending North Carolina State, NC State. Part of the essay that he wrote was about his involvement in community service. Also, he mentioned the fact that I have been working in this area for so long as well. It's a competitive university, and he did get in, and now he's attending right now. So we're all very fortunate. But, this was one of the things that we had in mind as we were, applying for him, is that we wanted to make sure that he had this in his background. Of course, I'm listing here for the Family Legacy Bill and Melinda Gates Foundation. That's the obvious. You look at how many billions they have spent, the billions of people who have benefited from their generosity globally for what they've done. You look at the employees and also the total amount of grants. Now, this is, of course, the extreme example. It doesn't have to be something like that. It could be something even small, even if you were making $5,000 contributions, giving it to a number of families, 100 families, for example, helping each one of them, that's still going to make an impact on anyone's lives. It may not be long-term impact for sure, but it's still going to be something that's going to help anyone. Third person to the left here is a friend of mine. He's not my son, but I've known him since he was born. And all of these are superstars, rock stars, these kids. And he set up this nonprofit, was extremely involved with it, and now he is attending Yale. And in fact, he's been so active in high school, not only with the work, the projects, this nonprofit. He joked that he was serious. Just since he's been at Yale, he doesn't go to class 5 days a week. You're only going 2 days a week, typically, maybe even 3 days a week. He didn't realize how much free time he has because he never had that when he was in high school, because he was so involved with stuff, including this nonprofit, getting it set up. So, it's been very successful, and it certainly helped him and every one of them as well, as they're kind of paving the way to their futures. And they certainly want to help others with science, technology, engineering, and math, because we know that's where the future is, and that's going to be helpful for any kids. So here's kind of my checklist. I'm going to go through here. I'm going to go through each one, except for that last one. We're not going to cover that one. It's not something that I don't think would be appropriate to sort of cover now. It requires a little bit more detail. So I'm going to skip that part, even though you're going to see it throughout today. These are the clients that we represent. The one that's the most popular, without a doubt, is that top one, the shared housing. It's a housing for recovery residents, elderly. To me, the most shocking is this aging out of the foster care. I mean, it's almost like a kick you while you're down. You're in the foster care because you cannot find a family to stay with. But once you turn 18, they're going to kick you out. So now you have to find a place to stay. We have clients who were victims, who were in the foster care system and aged down. They've managed to make it. They've succeeded. Now they're setting up their own shared housing to provide housing for those who have aged out of the foster care system. Of course, veterans is a common thing. Women who are victims of domestic abuse is also popular too. And elderly. For elderly people, as they get older, the house is too big. Sometimes they want to stay closer with a group of people so that they don't have to do the shopping. They can go do chores, have social events and social activities. It's cheaper because maybe it's difficult to afford. Residential assisted living may not be an option because it's too expensive as well. So, this is a common thing too. Of course, the recovery residence is a very big thing. Those who, run that risk of relapse, they have recovery residence where they're required to follow certain steps. They're required to have chores. They have certain duties, tasks they have to do. They're required to stay. They can't be out after a certain time. So there's a lot of accountability. And, it's called NAR, the National Association for Recovery Residents. So if you are a house that can get certified by NAR, then you, at the state level, because NAR is a federal thing, but there's state affiliates of this. If you can qualify for it, then you can also qualify for funding and grants. And this is why a lot of our clients love this option, because they want to do the shared housing, but they also know they can qualify for grants because there is a tremendous need in many areas. And we know for a fact, Washington is definitely one of the hottest areas for our clients. There's been a tremendous need there, and there may be in other areas as well, but this is definitely the most popular. There's also, affordable housing for low income, different standard, because that's for low income families that that fall below the income guidelines. So they're basically poverty level, or it could be, very low income and low income. That's the standard according to the income guidelines within the counties. Shared housing is not the same. It's not for low income, and it's shared. So it's not one family, it's multiple families, whereas the affordable housing typically be for one family. We also do the Humanitarian Relief, also, as we mentioned about STEM, helping children who are at risk, helping them with, science, technology, engineering, and math. We also have scholarships that they also do, is very common. Children with disability, videos to help teach the underprivileged, dealing with cash flow, financial independence, financial literacy, financial education, all of these things to help kind of break the cycle of poverty, to elevate them, to give them chances and opportunities to find good jobs. We also have several actually that are helping individuals obtain certifications in the technology field, which can help them potentially double their income. Now, it's not saying, doubling it from 100 to 200,000. It's roughly 50 to 60,000 is what it will be. That's how it's going to be, doubling it from 20 to 30 to about 60, which for many of these families, that's a tremendous leap in terms of the amount that they're going to be making. because they're generally about 20 to 30,000 is what they're looking at for a lot of families. So these are all the types of nonprofits that we help. I'm listing here kind of the benefits of forming shared housing. So here you see kind of all the benefits, kind of going back to what we were talking about with even with the Gates Foundation. What are the benefits? Well, these are all the things that, and there's many, as you can see here, just by forming a shared housing nonprofit. All of these are the sort of benefits that you get within a nonprofit doing shared housing. Of course, you can remove the shared housing and still say, I'm going to help the needy and the poor. And these are all the benefits that we're going to get in helping the needy and the poor. It will do all of these things too. An example that I like to use is water aid. I mean, 2 million people get clean water just through the donations. It doesn't take much, even if it's $25. And you think about a lot of areas. We have clients, and I've been fascinated by the stories of it with the clients, is that especially girls skip school because they have to walk to nearby villages in the morning. It takes them 2 hours, for example, to go walk there, to stand in line, to get water, and then come back. This can take 4 to 5 to 6 hours just to be able to get the water. And a simple solution would be to either have clean water or a water well in the village where they are, or in an area where they are. It's all it takes. And you can see there's a lot of organizations trying to help out with this. And it's amazing. 30% of schools don't have clean water, as it says here. Many people who also die from it because of the fact that it's not clean. So what a difference it makes just by making small contributions to these sort of organizations that are going to help some 2 million people. We do have organizations that do the water well as well, helping to build it in areas and in towns and in villages. It's usually throughout Africa is the place that they're looking at for these. This is the sort of impact report that, I like to even just show and highlight. As you can see, as a nonprofit, these are the sort of things that you can do and benefit. And in sort of showing these, anytime you want to get a donation, anytime you want to receive a grant, anytime you're seeking some sort of public funding, this is the sort of thing that you want to identify and highlight, showing them, this is what you've done, this is what you've accomplished. With the money that we receive from you, we're going to be able to, help and assist all of these people in all of these different areas. So I just grabbed one as an example just to show you kind of what's done. And nothing is more telling to me than showing numbers and statistics. And, for many nonprofits, they're just starting off. It's going to be very low numbers, and that's perfectly fine. At some point, the more money that you receive and the more that you get as public support, then the more people you're going to be able to help as well. So in setting up the nonprofit, and that's typically what we'll do at Anderson. We set up nonprofits, as I mentioned, some 200 last year, 250 last year, another probably 200 to 300 this year is what we're looking at. The question that always comes up is, I want to set it up as an LLC. I want to set it up as a C Corp. You can't do that. It can only be as a nonprofit corporation. So it's the Articles of Incorporation set up with a nonprofit. And, in listing the purpose for shared housing, this is what we will tell them in terms of the activities that the nonprofit does. It's a pretty simple procedure, but you have to have this dissolution clause. This is extremely important for nonprofits. If you don't, in a lot of states, you don't have to include it in there. But if you don't, it's going to get kicked out by the IRS. It's going to come right back. They're going to tell you have to amend your Articles of Incorporation. And I used to work at the IRS, and I used to get that all the time from taxpayers. We don't call them clients, we call them taxpayer there. They would tell us, look, it got approved at the state level. And I'm like, yeah, I know. That makes you a nonprofit, but it doesn't qualify you as a 501c3. So it depends on what you want. If you want to be a nonprofit, you don't have to include the dissolution clause. If you want to be a 501c3, you have to include the dissolution clause. So I'm just kind of highlighting the point of this is that, IRS is very particular about the information that you have to have. So as a nonprofit, when you incorporate it, you're technically an incorporator, but the one who's also incorporating it and setting it up, your name is on there as a director. Your name is on there as an officer. So you are presumably a founder. So any one of you who wants to set up a nonprofit, if you plan on incorporating it, whether it's you or us, you will be identified and termed as the founder, but you're not an owner and you're not a shareholder. And that's an important distinction because going back to this previous slide here, this dissolution clause is required by the IRS. And what is it that they want? Upon dissolution, and this happened quite a bit, and it still happens quite a bit right now, when people want to dissolve their nonprofit, they can't take the money back because they don't own it. They no longer own it because they are not an owner of the company. It is a nonprofit, which is a public entity. It's a public charity. So you're just a founder who has donated assets to it. So upon dissolution, it has to be distributed to another 501c3 organization. This is important and it's required. And if it's not included in there, then you will never qualify as a 501c3. So again, as a founder, you're not an owner or a shareholder. You're simply a founder. You're an officer. You're a director. So who owns the nonprofit? It's the public. It does not have owners other than the community at large. So who's the community at large? It's the public. There's no individual owners or shareholders. It's always the public. That's the one that owns the nonprofit. So once those assets, if you dissolve this nonprofit, the assets must go to another 501c3 organization. Now keep this in mind. So when we talk about profits, any money left over at the end of the year goes back into furthering the organization's missions. That could include salary, and that's perfectly fine if he does that. If you want to pay yourself, absolutely you can. Reasonable compensation based on the services that you're providing, the time, your involvement, the amount of work you're doing to help the nonprofit, absolutely you can pay yourself. The control. Now, no one person owns or controls a nonprofit. It's governed by a board of directors. Now, I understand this, and I know for a fact, many of you who think of setting up a nonprofit, it's your baby. You want to have some sort of control in it, maybe veto power. You can have that. You don't want to get removed. You know, you've set it up. You've helped this thing become a success. Then you add board members, and then you're all fighting, and they want to remove you. You know, that's a possibility that can happen. We've been dealing with that, you know, with several of our clients at this point. You know, they've been fighting, and now each one wants to remove the other person. So it's getting ugly. But you can have some sort of control if you want. Veto power, or you can't be removed at least. You're a permanent board member. And that's perfectly acceptable to do something like that. The assets, again, are held in trust for charitable purpose, and upon dissolution, it's donated to another nonprofit. So this is what's different from a for-profit entity, just the way that the assets are handled, are managed, the way they're spent and used, and then distributed either to the public or to another 501c3 if you do dissolve. So this is kind of the distinction between the two types. The ones on the right is a nonprofit organization or for-profit organization. The one on the left is a nonprofit organization. So you see kind of the profits. Where's it going? It's to benefit the public, whereas the profits are benefiting the shareholders for a for-profit entity. And that's kind of the distinction between the two. Of course, you know, the many people who have set these up, including, you know, I go back to Bill Gates, but it could be any wealthy individual. They put a lot of assets into the nonprofit, and they know, you know, that money is going to be used for a charitable purpose, and that's exactly what they want. They want to benefit as many people as possible, to help them, to benefit them, so that, you know, providing a public service and a public good to make a change in society. That's what they want to do. So they recognize they don't own it, but they do have control, maybe, you know. We can certainly, and we always tell the clients, do that, have control as to where the assets are going to be distributed. Absolutely, you can do that. Now for this no private inurement. This is a term that only comes up with 501c3 organizations. If you ask anyone what the differences between a for-profit and a nonprofit, they're going to tell you for-profit has shareholders, nonprofit has no shareholders, and that is true. But there's this other term right here, which is an even more important distinction between for-profits and nonprofits. It's a term called private inurement. So we see, sometimes, many times, it could be with a for-profit entity, this excess compensation. So what's going to happen? Do they get sanctioned or penalized? Not always. They get away with it, even though it's public information. It may be filed with the SEC. You're well aware of the fact that some people are receiving excessive compensation, and nothing is done about it. But if it happens in a nonprofit organization, something can be done, and it's either going to be by the IRS, it's going to be by the Attorney General, it could be by Congress, it could be by watchdogs or individuals that are reporting this. So if they see it, they report it, and these organizations can get penalized, and potentially they could lose their exemption. What it is it is a transaction between the nonprofit and an insider, whether it's a founder, officer, director, anyone who can influence the organization, and any family members. These are the individuals that these are the ones that are the insiders. So any transactions they conduct with that nonprofit organization, it has to be reasonable. You can do it, it just has to be reasonable. As I list here the types, and I keep emphasizing this because I know this comes up when I do the presentation. What comes up is, can I pay myself? Absolutely, you can pay yourself, as long as it's reasonable. Well, how about rental arrangements between the nonprofit and an entity that I own? Let's say I own real estate and I want to lease it and I want to rent it to the nonprofit. In a public charity, absolutely you can, as long as it's reasonable. Everything just has to follow reasonable standards. So what is reasonable standards? Well, ideally, you want to make sure that you are aware of what the cost would be for this activity or transaction. If you were to do it with a third party that was unrelated, you conducted a transaction with them, what would it cost you? And if whatever that amount is, that's the amount that you should be charged by the individual, that insider. So recommendation, it should be a written or oral arrangement, and it should be a written arrangement negotiated at arm's length, and it should be fair market value. It's that simple. And you do want to make sure that you have something that's in writing to ensure it. So here's an example. An organization is providing healthcare services, and they hire a management company to run the facilities. So all the board members are related, and they are the owners of the management company. So as you can see, they own the management company that's going to manage the nonprofit organization. That's where the potential private inurement could be. Now, is it acceptable? Yeah, you can do it. These are the best practices by the IRS. Now, I recognize a lot of you won't have this. It's going to be difficult to be able to come up with unrelated board members that are going to comprise the majority. You may have 4 family members. That means you got to find 5 unrelated members. And I can tell you, just working in Anderson, a lot of them want to add board members, but they're not always able to. Some can, but some can't. So it just depends on your situation. So you may not be able to expand it to add unrelated board members. And if you can't, that's fine. But you should, at the very least, look at the bottom. You can use the management company, but you should ensure annually that the fees are reasonable. Make a determination. What would a management company typically charge you? Get a quote from other organizations, other management companies. How much would they charge you? Let's say they charge you $4,000 a month. Okay, that's what the management company that you own can charge you as well. Something similar, $4,000 or less. It cannot be more. It could be less, or it could be up to that same amount. That's what you can do, but you have to ensure, again, this is what the industry standard is. This is what it would normally be charged if you were to use an unrelated third party. So you just want to make sure you are following the proper procedures and guidelines. Here's an example with Attorney General Keith Ellison. An organization had definitely abused their powers within the nonprofit. These were all of the issues that came up with it. And as a result, they were severely penalized. 4 of the 5 directors had a financial interest. That in and of itself isn't the issue. But the issue that you add is that, the relationship with the affiliates, which were owned by the founder, were never competitively evaluated. They weren't documented. They weren't negotiated at arm's length. And these were the items that I mentioned to you before. Competitively evaluated, needs to be appropriately documented, negotiated at arm's length. Now, we also had a few items here where borrowing money, they owed $700,000, and loans were not board approved. There were no written agreements, and they were not disclosed in the returns as insider loans. So you see, there was just one thing after another after another. So it's not just one item, but it's just the culmination of all these things is what led to this organization losing. At least they were penalized. Now, typically what's going to happen, the Attorney General is going to document this. Attorney General is going to write this up. They're going to penalize them, sanction them. Then it's going to get reported to the IRS. Then the IRS is going to come after them as well. When the Attorney General does something, typically IRS will follow. So that's the problem with what you see with some of these organizations. Proper governance. You know, the thing about a board is a board generally doesn't get involved in the day-to-day activities, just kind of at a high level. They're kind of looking at things and making sure things are being run smoothly. But you do want to make sure that the board is well aware of the activities that's going on within there. You want them to be involved in communicating. You want them to be involved with fundraising. For sure, they all need to be making contributions to the organization. You know, there's a lot of funders. That is the first thing they're going to ask is how committed is the board? Are they making donations to the nonprofit annually? So you want to make sure that you have a active board that's aware of the finances, aware of the activities, aware of the different committees, aware of the officers, aware of, you know, fundraising opportunities, and of course, making contributions too. All of these are key to the successful board. You know, a lot of people have the passion of setting it up, and it's a great idea, but there is going to be something that's going to be more involved with it as well. I just listed here director's compensation. I get the question all the time, and I will just say, yes, absolutely, a director can be compensated, but I don't recommend it as a director, because a director, you're just, you know, kind of at a high level. Even as I mentioned to you these things before, what a director should be doing, in reality, they're not as involved as, say, the president, the vice chair. They're more involved with the day-to-day activities. Even though the director, in terms of hierarchy, has the most power. Interesting, director can remove officers. Directors can remove directors. An officer cannot remove a director, and an officer cannot remove an officer. It's only the director that has that power. But we know a lot of nonprofits that we represent that are directors. They're also the officers. They also are program experts. They're socially connected. They do fundraising. They do marketing. They're part of committees. All of these things would justify you being able to pay yourself something. And when I say pay yourself, not as a director, but as an employee. You know, when we do our applications, we never list that directors are being paid, because we know 100% of the time, the directors are doing a lot more than just being a director. They're also being officers, and they're also being employees. So yes, you can pay yourself, but I always tell you, pay yourself as an employee, because there's so much more that you do than just being a director. For your filings, every nonprofit is required to file a tax return. It doesn't matter what the size is. Even if you set it up this year and you don't do anything until next year, you still have to file a tax return. The year that you set up the nonprofit, you have to file a tax return. The filing deadline for almost all of our clients is May the 15th. That's when you have to file it. You can get a 6-month extension, so it will be November the 15th. And that's what we do for all the clients as well. We always file the 6-month extension. Now, we may file before May the 15th, but we still do the extension, and that's fine. You can do the extension, and you should do it just in case. But all nonprofits, if you've been set up, anyone that was set up December the 31st, 2021, is required to file a tax return this year, regardless of activities. If you've been set up and you want to be a 501c3, then you must file this year. Depending on the size, we have a lot that are doing the 990N. It's a simple postcard that can take all of 3 to 4 minutes if you do it online. They call it a postcard, but it's all electronic, which is pretty interesting. They used to have a postcard when they originally required this, but now everything is just done online. Then there's the EZ. If you have assets of less than 500,000 and you've received less than 200,000 in a year. And then finally, there's a long form of the 990. I'm not going to go into detail about the tax returns because, you know, that's for another time and place. But the whole point is just to let you know, as a nonprofit, you do have to do a filing every single year. And for private foundations, it's this 990PF, which is a very lengthy tax return to do. You may not fill out much of it, but you are required to file it as well. So all of these are the types of filings that you have to do at the federal level. At the state level, some states don't even require it. So we have a lot of clients in Nevada. We have a lot of clients in Texas. They don't do a state tax return. California is the worst. You have about 4 things that you have to file. We do it every year. Even if you're not incorporated in California. We have a lot of clients who are in Nevada, but they are operating in California. So now they have to foreign file in California, and they have to do tax returns in California. And there's up to 4 returns that you have to do there. You have 2 that are state. One is a financial disclosure, the other is a state tax return. And then you have to do one applying for the exemption, tax exemption. And then finally, you have to do charitable solicitation registration. And California will tell you for that charitable solicitation registration, you know, the whole point of that is if you are going to fundraise in a state, the way it works is they want you to register in their state because they want to protect their constituents. They want to protect the residents from you in the event of fraud. They don't want that to happen. So what they want you to do is register. But California says, even if you have a website and residents from California can donate on that website, then you have to register in that state. Wow, I mean, that's ridiculous if you ask me. And I know many, many, many organizations don't follow that. We always tell our clients, at a minimum, register in the state where you are incorporated if you're required to do that. Charitable solicitation, I'll mention in a minute, and also the thank you letters as well. Both of these are extremely important. Solicitation registration. Before you ask someone to donate, in that state, you must register with the appropriate official. Not all the states require it, so it just depends on what state that you're in, they may. So there's at least 40 and 41 states, and they have different requirements and different filing deadlines. If you're a church, in most of those cases, you're exempt. You don't have to do it. Also, if you don't raise more than a certain amount, you may not have to do it either. So there are certain exemptions that may apply. These are some of the examples. Obviously, the big fundraiser when you have a gala, you know, that you're going to be holding somewhere, that would be an example. I've listed here the crowdfunding events, such as Facebook or GoFundMe. You know, that just kind of expands it to say, do I have to file and register in all 40 states? Not every state is going to require you to do it. But again, like I mentioned before, states like California would require you to do it. So these are examples of what may require you to do charitable solicitation registration in a state. And again, it's any of these types of fundraising activities where you're trying to raise money from donors within the state wants to protect their residents. This donor acknowledgement letter is extremely, extremely important. Anytime you make a contribution to a nonprofit, you need to get a letter from them. You have to. The canceled check won't work if it's more than $250. And it has to include certain language. ABC Charity thanks John Smith for the contribution of $3,000 in 2021. No goods or services were given in exchange for this, signed Charity, Jane Smith, for example. Or it could be even John Smith, the one who was the founder of it, is also the one who made a donation to it. You can do that, and that's perfectly fine. But you have to include this language here that says no goods or services were given in exchange. And I'm directing you to publication 1771, because the first thing I do when I get these letters, I look to see that it has that sentence, no goods or services were given in exchange. That exclusion of that sentence right there will can disallow that contribution that you made. I'm going to show you a few examples in a minute. You're going to see just how crazy it is. So real estate or crypto have different sets of rules. You have to get a qualified appraiser for the real estate, for sure, based on what the fair market value is of the real estate. Crypto, you have to do the same thing. Now, if I donate stocks, all you have to do is go to the market, look and see, look what the high is, look what the low is for the day, take the number in between, that's your average, and that's what you can say was your contribution. Crypto, you can do the same thing, but you're not allowed to. You have to get a qualified appraiser, and you have to fill out this form, which you don't have to do with stocks. Problem is the IRS has been very, very slow to making changes with how crypto has to be reported. That's the challenge that we have. These rules are old. They're treating it like real estate and not like stocks. Even though you have a market 24/7, unlike the stock market, you still have to do it this way. You need the donor acknowledgement letter, which is what we were referring to in the cash donation, IRS Form 8283, completed by a qualified appraiser, signed by the appraiser, signed by the nonprofit. All these are required. Please see publication 1771. Here's another important requirement. It has to be contemporaneous. This is extremely, extremely important. That means before you file your taxes, you need to receive a letter, an acknowledgement letter from the charity that follows the IRS requirements. As I mentioned on the previous slide, no goods or services were given in exchange. Thank you for the contribution, specifying what the amount is. And I listed here, I put it aside, must contain the language, no goods or services will provide in exchange if that is the case. This is extremely important. I get this question too. How about a contribution of services? No, it's not tax deductible. If I provide free legal services and I would normally charge $1,000, I can't deduct $1,000 for that. However, I can deduct any expenses I incurred. Let's say supplies that I had to pay for, shipping, postage, driving to the post office to ship it, for example. Any of these expenses that I incur with that, those are deductible. But the services that I give them for free is not deductible. Here's a case that it came out in August, and they just came out with an article about it. And what's important here, the first acknowledgement, there were 2 acknowledgement letters they were supposed to receive. The first one was missing the required statement that I mentioned. No goods or services were given in exchange. The second, while containing the necessary information, was issued too late to be contemporaneous. Contemporaneous, as I mentioned here, contemporaneous. It has to be given, this written acknowledgement here for the contemporaneous statement has to be given before you file your taxes. It has to be. Or if you file for an extension, before you file it with the extension. So let's say you were going to file it September the 15th. You have to receive this letter before September the 15th. It's extremely important. They weren't denied $25,000. It was actually over $1.2 million was the amount that they were denied. Even though they acknowledged that the individual made the donation to the charity. They weren't disputing that. It's just that they didn't follow the requirements. There's no substantial compliance that's allowed. It is strict compliance. You have to follow it. These are examples of cases where individuals were denied the being able to take a deduction on their tax returns, $64 million, because the written acknowledgement was not contemporaneous, and it didn't state that no goods or services were provided. So it didn't have either one of those. We had another one disallowed for the same reasons. What's important is the tax court did not dispute that the contributions were in fact made, but they allowed it because it failed to comply with the requirements. Others is $1.8 million were disallowed because that Form 8283 that I mentioned to you before, it was filled out, it wasn't signed. So you can see just the minor things here that are done to these can disallow it if you ever get audited. And the same thing with the charitable remainder trust. They failed to provide the proper appraisals of the property. Again, all of these are extremely important. Here's an example of an audit, nearly $300,000, same thing. Imagine with this one, you're going to lose about $120,000 in deductions that you were able to take for these charitable contributions. If you just assume, I don't know, we'll say 40% tax bracket here, then that's what you're looking at roughly. About $120,000 is what would be disallowed, plus penalties and interest. So it can be quite severe, these penalties, if you don't provide the information and you're not able to substantiate the deductions, the expenses that you incurred, and you don't follow the guidelines and the requirements that the IRS is requiring all donors whenever they are. Whenever charities receive these contributions, they're required to issue these to the donors. And not all organizations do that. I'm still fighting with an organization about this, of giving it to me because they had the wrong date. They put 2021 instead of 2022. It's unbelievable. So I'm asking them to change that because yes, I did receive it before I filed the return, but there was a clerical error with that. And I'm still trying to get that from them. It's unbelievable. Crypto, as I mentioned to you before, it's non-cash, so it's 30%. You need that 8283. You need a qualified appraiser if it's a donation of more than $5,000. The nonprofit and the donor both must receive a copy of the return. Now, we're assuming that you own it for more than a year and it's appreciated. Keep in mind, if you own it for less than a year, you can only deduct what you paid for it and not the appreciated value. And that was going back to a long time ago when I mentioned in the beginning, you can donate appreciated assets. If you've held them for more than 1 year, then you can donate the fair market value of that for the appreciated assets. So it depends on whether it's been for more than a year or less than a year. For more than a year, you can deduct the fair market value of the appreciated asset. For less than a year, then it's going to be what you paid for it. Property with debt is a bad idea. You need to speak with an advisor before doing it. You know, I've had clients say, hey, I've donated property for $250 and it's the mortgage $200,000. I can deduct $50,000, right? Yeah, well, yeah, but you also got to pay $160,000 in taxes. You're actually going to pay taxes under this scenario, believe it or not. Why? Because the mortgage as a percentage to your overall equity is very high, and the amount that you paid for the property is very low. These were the two factors in deciding this, because you have to split it up. Part of it is a sale and part of it is a gift. The sale is the mortgage compared to the amount that you paid. And that's the problem. You know, you need to speak with an advisor. Don't ever donate property with debt to a nonprofit before you speak to an advisor about this to run the numbers. That's my caution to you. Now, I get questions all the time about private foundations. I want to do a private foundation. It sounds appealing. You know, it's got this, you know, it's got this thing, an appeal to it and a charm that you're setting up a foundation, is that it sounds like, you know, you're really building that legacy. And you don't have to have a private foundation, as I mentioned before. Look at all these examples here. These are things that a private foundation cannot do. Remember when I mentioned about private inurement, and I mentioned about the transactions that you can have with insiders. You can do them if it's at fair market value, follow reasonableness. You can't do that with a private foundation. Let's say you wanted to lease property, even if for $1, for $1, you can't do it. It has to be for free. Sale or exchange of property, the management company that I gave before, you can't do it. Furnishing goods, services, or facilities, you can only do it for free. You can't do it if it's for $1. All of these things are prohibited between the private foundation and the individual. Loans, absolutely not. You cannot do that. I don't like loans personally, but sometimes we have seen it where clients do the loans, and there are legitimate reasons why they're doing it. For example, they're taking the loan because the only way they can do it is personally to buy property, because they're having a hard time being able to get any sort of loan for the nonprofit. Nonprofits are going to have a very tough time getting loans. So certain types of transactions, we say, okay, you know, it's fine with a public charity as long as you follow the reasonableness standard. These are clients of ours, and these are examples of what they do. Sometimes as I listed here, DP is a disqualified person. I think I had that listed here before on this slide. Disqualified person. So you can have shared housing where you may own real estate and you lease it out to the nonprofits. It's acceptable if it's reasonable, prohibited with a private foundation. So you see all of these examples. These are things that a lot of our clients, may do. And these are all acceptable doing it this way. For-profit subsidiary, I personally don't like it too much, having these subs underneath a nonprofit. It's too much and more than many of these clients really need. But you can do it, but you can't do it with a private foundation. A lot like to do international grant making. You got to follow certain guidelines and procedures. Otherwise, it's going to be taxable. Even if it's charitable, even if you're giving it to poor, to the needy, you're building the well we were describing before, those sort of things, those can be taxable under the private foundation. Finally, grants and donations to non-501c3s. Let's say you want to give food to homeless, a soup kitchen. You go to McDonald's and you buy a bunch of Happy Meals, or you buy a bunch of meals. I mean, that's not a 501c3. Well, a public charity can do that, but a private foundation cannot do that. At least you can't report this as being something that you've done with a private foundation as a grant, because it's not acceptable. You can't do that. So you can see there's some really important distinctions between public charities and private foundations. So I'm sort of wanting to preempt, because I know a lot of people keep asking about the private foundations. And that's why I'm kind of just highlighting that. Last thing, finally, we're approaching the end here. Public disclosure. There's no anonymity with nonprofits. When we do the application and we list board members, sometimes the board members tell us, this is my address, this is his address, this is her address. And we always say, listen, we're giving one address. It's the nonprofit's address. That's the only address we're going to use. This is the best way we can do the anonymity. And in Anderson, we have that McLeod Drive address, which we've got thousands and thousands of clients using that address. We'll use that for our clients as well if they want the anonymity, because we can't remove their name. So we'll include their name, but use the address that we have in Nevada. That's the best we can do for anonymity. You have to disclose and include all of these items anytime someone wants records and documents from you. It's required. It's required by law, public disclosure. So you can't hide them if they are officers or directors, unfortunately. So these are all the things that are required. Make available for public inspection or copying upon request. It's sort of my shameless plug here. It does take a lot of work doing a nonprofit. And for many of you who want to do it, I know it can be challenging, but for us at Anderson, we do these every single day. So it's new to you, but it's not new to us. We've done hundreds and hundreds of these. I've done over 1,000 over my career. So, I say, if you want someone to help, please let Anderson do it for you. We do set up the nonprofits and apply. We do the filings, the compliance, state and federal filings and the compliance. And we also have something we call this mastermind program, which is relatively new, but it's an opportunity for nonprofits to meet other nonprofits. In terms of processing times, and I'm just going to give you some general information with this. First, let's assume right now they're accepting applications from February the 15th, because this says August 24th. When I looked this up about a week ago, that was the latest. It was August 24th. Let's assume it's the middle of September now. So February, it's taking 7 months for applications. Now, I do recognize it's going to vary, but these are the applications that we have done over the past few weeks. And you can see that most of these have been approved. There's 3 exceptions here that were filed in January. It's honestly, in those situations, it's the agent's fault of claiming that we didn't include certain documents in there, but they were included in there. But for whatever reason, everything has to be filed electronically, and not everything goes through for whatever reason. They still have issues with this. But all of the others that you can see, these are getting approved, some in 3 months, others within a month. This one on August the 26th is the most impressive. I've done over 1,000 applications. This is the fastest I've ever seen an application approved. What's even more impressive about that one is August the 26th is a Friday. So the 27th and the 28th are weekends, then the 29th and the 30th. So you're looking at about 2.5 days. Now, what was that? That was shared housing. And what's happened is we've been telling the IRS every time we file the shared housing application that we have done X number of shared housing applications before. These are all the organizations. These are their EINs. These are when they were filed and when they've been approved. So the IRS is now looking at them and basically rubber stamping these. So they're getting approved extremely fast. We had others here from Humanitarian Relief to low-income housing that are part of this as well, but you see that they're all getting approved fairly quickly. Now, of course, past performance, just like with stocks, is no indication of what the future results will be. But, you know, we've been seeing applications getting approved quicker and quicker and quicker. These are what Anderson does in terms of the services of doing the application. Not only do we prepare the application, we do the bylaws, the minutes, the resolution. We will complete everything for you. And what I'm highlighting here is this weekly Q&A session. I love it. This is something that we added recently. Last year, we did it as a pilot for about 6 or 7 sessions, and we liked it. We had tremendous turnout at that time, so we decided to just keep going. So now we've decided to just sort of keep it, you know, as long as we can. Every Tuesday, we do it for about an hour for anyone who's setting up nonprofits with Anderson. So people hop on and we'll ask all their questions. And I can tell you, working at a firm, you know, we billed out, I was billing out at over 400 an hour. So any phone call of 10 to 15 minutes, you know, we got to bill them. You know, sometimes it's a couple $100 for these phone calls, you know, asking questions. But here we have clients who are coming and hopping on every week and asking some questions. We've had one client ask us 24 questions in one session before. So it's amazing. So we get, you know, about 20 questions. Definitely the bad dad jokes. I'm just, you know, I'm on fire sometimes. I think we had a session today. I think I had about 4 or 5, including singing. I was singing "Oh Sherry" by, you know, Steve Perry. The boomer moments, we all share in that, all of us, you know. We're having a problem with technology a lot of times. So, you know, we're never going to figure it out. But, you know, these are a lot of the questions that we get. Some are very substantive questions and excellent questions. Others procedurally, others deal with governance, others deal with filings. So we get a whole range of the stuff, but they come armed, they come ready, asking us as many questions as they want. And, you know, we do it for an hour. So I love it. Of course, the company compliance was another thing that we do, and you get access to that donor acknowledgement letter. That to me is probably one of the most important things. You know, I mentioned to you before about that donor acknowledgement, that contemporaneous written acknowledgement. You got to comply, because if you don't, it's going to get disallowed if you ever get audited. And that is a challenge. We don't want that with any of the clients. You know, I don't care whether it's $5,000, $10,000, or $100,000 or $1 million that you make. You don't want it to be disallowed, that's for sure. In addition, we do the solicitation registration and we do the tax return. So we do all of these things for the clients. Nonprofit Mastermind is something that we also do, giving them an opportunity to meet with other board members. But we also have speakers who come on to talk about fundraising, marketing, websites, Google ad grants. We have 6 monthly 2-hour meetings, but it's actually more than that. We have at least 10 to 12, and we are going to just keep expanding it as long as we can, because we keep listening to what they want, and we want to make sure that they are all successful. That's the key to us. We really want to help everyone, these nonprofits. I don't like just doing the 501c3 and saying, you know, so long and good luck. You know, you're on your way. That's all we can do. We want to help the nonprofits more than anything. We want them to be successful. So these are some of the examples of the speakers that we've had to come and speak to the nonprofit and some of the resources that we give them. We give them, whether it's articles, videos, you know, webinar recordings that we have. Of course, we have the speakers that come on there too. We give them checklists, we give them sheets, all of these things we give them to help them, as long as they're interested in learning about the stuff. Because, you know, unfortunately, you can have the speakers all you want, but you're still going to have to be able to do this yourself. You're going to have to be able to go there and learn about this. Giving Tuesday is an important day, also the year-end fundraising. All of these are extremely important. And I tell all of the nonprofit mastermind members, if you just come and attend, you're going to get a return on your investment for all these things. So please, come and join. Please be a part of it. Please join the nonprofit mastermind. So there were 3 different services that I was mentioning to you before. One was dealing with a 501c3. Separately is the compliance package. And then the third is a different package with the mastermind. So if anyone wants to sign up for a strategy session, here is the link right here. You go to that link and you can just fill out the form and then someone will reach out to you. So that concludes my presentation. So even though I had about almost 70 slides, I did it in about 70 minutes. So 70 minutes.
Awesome. All right. So let's, Karim, amazing information. Let's take some of the questions that we've had. And normally we keep this to 90 minutes, but we're going to get through your questions tonight. So Rashay, what are the most common mistakes unsuccessful nonprofits make?
Some of the mistakes they make is they assume they're going to raise more and they don't. That's the biggest challenge, is that they think that once they set up the 501c3, the funding is going to come in. And it's not. It's very challenging. The other thing that they assume is that they can do multiple things for that nonprofit. They think they can wear many hats. They think they can be an officer, director, be the treasurer. They also think that they can fundraise. They can work on the website. They can reach out and network to donors. They think they can do all of these things, even whatever it may be, work on the computer, working, kind of doing the administrative stuff. And it's a lot to do for one person or 1 or 2 people, that you do want to enlist volunteers to come and be a part of it, or employees if you have to be a part of it. Because if you don't, it's going to take a long time to get to where you need to be. That's the problem. So that's one of the biggest challenges and mistakes that many of the nonprofits do.
That's interesting, because you have a business to run, whatever that is, if it's shared housing or residential assisted living, whatever you're doing, whatever you've got to run that business, and you've got to go out and solicit and market and taxes and compliance and everything. Yeah, that's interesting.
That's
okay.
A lot to do. And I should say, just sort of as an analogy, when I used to file these applications, I did all of those things. And then when I came to Anderson, they're like, look, we have the people and the resources that we're going to split the time up. We're going to have someone else set it up for you. You just need to meet with the clients, put together the application. Someone else compiles all that and sends it out. I can't tell you how much free time I have now. It's so much easier, and you don't realize it till you have someone else involved in it, that, you want to be able to delegate the stuff, to have other people do it, and not just you being that one person to do everything. Because remember, even as you mentioned, even with that, on top of that, you have a full-time job somewhere else that you're doing, because that's where it's going to pay the bills to do all this too. So
correct. All right. John is asking, do you still represent public charities in audits for a fee?
I mean, we don't do it within Anderson. I used to before, but it's difficult for me to do it now outside of Anderson. I can't do that while I'm working with Anderson.
Okay.
Maybe I'll follow up with you and see kind of what the situation is. But I don't think we'll be able to help you with that.
So John, write us an email at Protect Wealth Academy. Kendall, will you put in my email address or yours, and then we can forward that to Karim and he can answer that publicly. But the answer is unlikely. How's that? Is that fair?
Yeah,
okay.
Unlikely.
Okay. Anonymous is saying, how does the nonprofit have to focus on just communities, or does it? Does the nonprofit have to focus on communities in the U.S. or can it be abroad as well?
No, you can do it. You can do it internationally. You can do it abroad. The only caution about international is you want to check the OFAC, the Treasury, the Office of Foreign Asset Control, their website, because there are certain countries that are sanctioned that you can't work with, or even if you're doing charitable relief and you want to build the water well, as I mentioned before, you want to give clothing, you want to give food, Anything like that, you have to have a license if it's a sanctioned country that's prohibited, that you're prohibited from doing trade with. So you can do it internationally, but just verify that it's not on that list. There's about maybe 20 countries at this point. So if we say, for example, I'm from Egypt, so Egypt's not on the list. So if you wanted to give to Egypt, absolutely you can. As long as it's serving a charitable class, you can do that. Yeah.
Okay. Question: Do you do CRTs, family foundations?
We don't do the charitable remainder. We do charitable remainder trusts, but not within the context of a 501c3. And the reason why is because of that dissolution clause that we were mentioning before.
Right.
The dissolution clause, it has to go to a 501c3, and the charitable remainder trust really doesn't have that same requirement with that. So there have been some instances for quite some time now, they've not been accepted as 501c3s. So, we do have within Anderson, they do charitable remainder trusts. Absolutely. We have someone who's very good at doing that. We just don't do it within a 501c3. That's all.
Great. What's the difference between a 501c3 and a not-for-profit business?
Well, it's not much different, but a 501c3 is your certification from the IRS. Okay, I see. So like a not-for-profit or nonprofit, it's typically a nonprofit is what they'll call it, is that a nonprofit is a recognition at the state level. So all that's required to be a nonprofit is you file, you basically fill out a nonprofit corporation, you submit that with the Secretary of State, and you're recognized as a nonprofit. 501c3 is a certification at the federal level. So before you can be a 501c3, you have to be a nonprofit. That's required. So you have to be set up as a nonprofit first, and then you can apply to get the certification as a C3. And if you donate to a nonprofit, it's not tax deductible. If you donate to a 501c3, it is tax deductible. So that's the important distinction between the two.
I was very impressed with your approval time, because generally most of the people that I've worked with, it's taking their normal CPA, it's taking 9 months to get an approval and their first denial, and then it goes through again, and then they get another denial, and they submit everything. And so I've seen them take 1.5 years, 2 years to get approval. That was impressive to see your numbers.
Well, thank you. The thing with the applications, because I used to review applications, and we always had to prepare a memo to file. We have to explain why the organization qualifies. So when I was preparing the memos to file the IRS, we have to, cite anything that's going to support the position as to why it qualifies. So that's what I do now, is that I'll cite IRS positions, IRS revenue rulings, any cases that will support it. So I'm always including that as part of the application to show, based on these rulings, the organization is doing the same thing as these, organizations described in the rulings. So, as a result, it should qualify for exemption. So I always include that in there to help expedite it.
So you're doing all the work for the IRS auditor who has to approve it.
Yeah.
It's impressive you've been on both sides.
Yeah, and I've actually gotten very good feedback from them when I spoke to them about it, is that they said, basically you did help expedite it by just citing all this stuff. So you made it a lot easier for us.
Okay, Patricia's asking, how about the college students and young millennials living at home? Can we do housing for that in a nonprofit setting?
Yeah. You can do it for college students. They have for college students too.
Okay.
Housing, yeah, absolutely. You can do that.
Okay, next, can a nonprofit support poor and needy, underprivileged in other countries? I think you answered that. Does the nonprofit have to establish an international office?
No, you don't have to have an international office. You have to follow certain requirements whenever you are doing internationally. The only thing that you have to do is, ideally, it helps that you work in conjunction with another organization. It would help. just to make it easier. But the charity in the US has to have discretion and control over the money. So if it turns out they want to give internationally, but it turns out that the money is not going to be used for the charitable purpose, there may be corruption, someone's going to steal it, then you can withhold it at that point. So you want to make sure that you have control over that before giving it, and that's all. That's the important.
You talked about the anonymity for the board members, but don't they still have to list their social security numbers?
No, not in the application. No.
Okay, so the IRS doesn't see that.
No, the only social security number you would have is when you're applying to get your EIN, and that's only one board member that you have to have.
Cool.
But no, you don't have to include the social. In fact, IRS, they don't like, they're like, they don't like communications through email because they're afraid of, information that's going to get stolen. So they don't they'll do it usually by the mail if they're going to do it. And even now they just give you the last 4 numbers of what they're going to show.
Okay, what's an average cost that students should expect if Anderson were to set up a nonprofit?
Anderson they charge $4,000 to the nonprofit. Is the general rate. They had a promotion, and I don't know if they're still going to be offering the promotion or not. But so I'm just going to tell you for now, at a minimum, or at the most, it's going to be $4,000 is what they charge to set up the nonprofit. And I just keep saying, you were setting up the nonprofit, but we're not done with you. We'll continue. You get the sessions and come join the sessions and come ask as many questions as you want and email us as many times as you want. I once thought that 4,000 was a lot, but now as we're doing a lot of these Q&A sessions with the clients, and they're coming back every single week, and we're asking, they're asking a lot of questions, dozens of questions with that. I think that's where the value is for sure to me.
I'm incredibly impressed if it's $4,000, because what I'm hearing in the locals is that it's taking almost a year to get approval, and it's costing them anywhere between $10,000 and $15,000 to get a nonprofit. And this is to do the application with the IRS, as well as the paperwork, the bylaws. That's impressive.
Yeah. And we got results. I've never had an application denied up to this point in my career. So I'm proud of that. And of course, it doesn't mean it's going to continue that way, but we're always cautious about every application because we want to make sure these things get approved and get done the right way. But if you come up with an idea and it's not a good idea, we can help you about restructuring it to make it work. And we've done that dozens and dozens of times, and they got approved. So we got it before we were going to file it as well.
Okay, Sean, one of our brand new students. Hey, Sean, setting up a nonprofit is my life's goal. I will set it up for youth programs. However, I'm buying real estate and planning to do shared housing. What are the benefits of doing shared housing as a nonprofit versus a profit corporation?
Great question. So the biggest benefits you're going to get between the two is you can qualify for funding. That's the biggest thing, in grants. We've worked with another group that deals with this, and the thing that they have done. Now, I'm not involved in applying for the grant, so I'm not going to tell you from my experience, but I'm telling you from their experience. A lot of states, if you can get the certification, they will give you funding for the houses. And on top of that, they're going to give you funding in some instances, not always, but in some instances, they can give you funding based on the number of rooms that you are going to accommodate people for. So if you have 8 rooms, they will give you grants and funding to cover 8 rooms, even if they're not filled, which is unbelievable. But that's what some of the states and counties can do. You can't get that if you're a for-profit. You have to get the 501c3. That's the requirement to get that sort of funding from the states. And the government, and typically government grants, primarily they're looking at nonprofit organizations. So, that's one of the ways. My recommendation, if you're still on the fence, you can set up and apply for exemption. Just don't put any of the assets in the nonprofit at this point. So you kind of have it in your back pocket, and you can always use it, to your benefit and to your advantage. So if you have the exemption, if you want to move the property in, if at that point the state is saying you need to do that in order to get the funding, then that's when you can do it at that point.
We just had a student, I think 2 weeks ago, gets two $75,000 grants to do shared housing up in the state of Washington. He's building 2 homes. He's got the homes, he's got them ready. And now he's trying to put residents in, and two $75,000 grants. He was working with Chris Johnson, and I found that the application process to be really quite easy to do. So I agree with you that there's grants and loans available to nonprofits, but Karim, let me ask you, if somebody is just starting out, never done a shared housing, would it be better to do the first one, make a little bit of money, then have a little money and have some experience, and then do a nonprofit? Is that the best way to do, or what's your advice as you've watched hundreds of people go through this?
Well, what we've seen with a lot of our clients, though, is they've got the nonprofit and they may just lease the property to the nonprofit. So they own it still personally through an entity, a C Corp, for example, or an S Corp, and then they're going to lease it to the nonprofit. So that's what they've done as starters. And then if they decide maybe at some point they want to move it into there, because they still may qualify for funding, even if the nonprofit doesn't own it, just having that certification for that nonprofit is all that they need. It follows the C3, it doesn't follow the property. So that's,
and they can still take a reasonable salary and lease the property to themselves for a reasonable fee. So they can still make money.
Exactly. Yeah, you can do
and
that.
still be eligible for grants and loans and scholarships or whatever. Okay.
Yeah, you can. Some may say that you have to have the property in there. It's just going to depend. But it's funny you mentioned about, we actually had a client, the same thing, where two $75,000 grants in Washington, and it was contingent on him getting the exemption. So we got it expedited, and they got it within less than 2 weeks.
Cool.
So it was the same thing. That was in Washington, as I mentioned in the presentation. Washington seems to be the place to be if you want to do shared housing, because that's where the grants seem to be for people. So I mean, it's an opportunity if you want to work in this area.
Okay, just a couple more questions. Dr. Johnson, does your company assist with donor advised funds?
And I see the second question. I'm not sure if you're asking if we do donor advised funds. So Anderson, we've set it up so that you can, but it's not going to be outside. It's going to be only people within that nonprofit mastermind is what we're initially thinking, because we just got it approved by the IRS. That actually was the longest application it's taken, was the donor advised fund that we've had, which is fine because it's not a client. The client was Anderson, so I was okay with that. But the problem is, operating a donor advised fund, Anderson would be responsible for managing all of these accounts that are set up within the donor advised fund, and that's going to be more than we can handle right now. So for the time being, we're not doing the donor advised funds until we can figure out whether we have the people in place. You can set up a donor advised fund through a place like Fidelity, a place like Schwab and Vanguard. You can do it over there, and it's very easy to do if that's what the question was. But I see your next question is that I like to set up my nonprofit and be able to accept donor advised funds. You would need to go, again, because Anderson is not going to be doing the donor advised funds, you would have to do it through, let's say Schwab. You go to Schwab and you say that you want to list as one of the recipients of the donor advised fund is going to be your nonprofit. You can do that, and most likely they're going to approve it as long as you're a 501c3. Now, the only caution is if they see that there is an overlap, it's, you're on the board and you're also the one with the donor advised fund. If they see that, they may not allow it. Some of them have that restriction, and I don't remember which ones do and which ones don't. So
Okay.
that's the one thing to caution you about, is that if you want it to go to your nonprofit, your 501c3 from the donor advised fund, if they see that there's a common name and a common individual as part of it, then they may not allow it.
Students, thank you so much for being on. We know that this has been a little longer than we normally do. Karim, what does it cost to do a strategy session? I see the link still on there. They can go there, do a strategy session. What is that going to cost them to do a strategy session?
As far as I know, it's free, the strategy session.
So it's 15, 20, 30 minutes, do a strategy session, see if what you're looking for fits what works.
Yeah, I'm just clicking on the link right now. A 45-minute strategy session. And I know that these are free.
So you really have nothing to lose by if you have additional questions. Karim, absolutely appreciate your expertise, your time. I know it's late where you're at. Thank you for sticking up with us and doing this. But students, we couldn't make it easier for you. If you have questions, if you think this is for you, encourage you to sign up for this strategy session and see if it's going to work for you. I can't believe your pricing. I can't believe your approval time. It's absolutely amazing in this industry. Any closing thoughts before we wrap it up for the evening?
No, I mean, I thank you for the questions. I thank you for the opportunity. And again, yeah, you got nothing to lose with the strategy session. Just sign up and see. It's a free 45-minute. See if it works for you. I love Anderson. I think that the tools and the resources they provide for everyone is more than enough to help. So, again, sign up if you're interested in setting up a nonprofit. Because I love anyone who wants to make a change in the world, so in society. So
there we go.
Opportunity.
Absolutely appreciate you being on. Students, thank you. We know it's late. We appreciate your time, and Karim could not be more grateful to you for your time and expertise. Thank you, everyone. Have a wonderful evening. Good night.
Thank you.
Bye-bye.